You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
If you've been glancing at the market headlines lately, it's felt less like a steady climb and more like holding on tight during some pretty unexpected twists and turns. We've seen some real volatility, haven't we?
Absolutely. Yeah, it's a market that seems very sensitive to just about any signal right now, and we've certainly had a whole flurry of them recently, leading to some, well, pretty rapid shifts in sentiment.
Okay, let's unpack this then, because in this deep dive, we're looking squarely at what's been causing these recent market gyrations. Our goal is really to go beyond just the headlines, understand the core forces at play. We're focusing specifically on statements coming out of the Trump administration about trade and the Federal Reserve, and then layering that with a look at other key global economic indicators. We've pulled together recent financial news reports to help us connect the dots here.
And it's vital to remember that while we're looking at these factors individually, they don't operate in a vacuum, do they? They're all pieces of the same sort of interconnected economic landscape. They all influence each other.
Exactly. So let's start with what many are calling a relief rally, essentially a quick upward surge in the market as some of that negative pressure seemed to ease off. We saw stocks jump, the dollar actually strengthened a bit. What was the primary trigger for that initial positive burst?
Well, the main catalyst appears to have been President Trump's clear statement that he has no intention of removing Jerome Powell as the Federal Reserve Chair.
Ah, right.
And this was significant because just before that, the market had been quite anxious. There were the president's social media posts, reports suggesting he was maybe considering options to do just that. It created a lot of uncertainty.
Right. Those reports really put the Fed's independence kind of in the spotlight, didn't they? And maybe for folks who don't follow this super closely, why is that independence such a key factor for market stability?
Well, fundamentally, the market relies on predictability, credibility too, especially when it comes to monetary policy. So when there's even a perception that political pressures might influence the central bank's decisions, things like interest rates, it just creates uncertainty about where the economy's heading.
Yeah.
And that can really undermine investor confidence.
That makes perfect sense. And the dollar, it took a bit of a hit during that period of uncertainty, didn't it?
Oh, absolutely. Yes. The dollar had actually fallen to its lowest levels since, I think, December 2023. It was a direct result of that apprehension around Powell's position.
Wow.
So the president's later comments essentially just walked back those earlier signals. It offered a sense of stability, regarding U.S. monetary policy. And that reassurance was a major reason we saw that initial upward move.
Okay, so the Fed news definitely calmed some nerves. But it seems like the positive vibes, they kind of extended beyond just monetary policy. Trade seemed to be a factor too.
Absolutely. Yeah, pretty much concurrently with the comments on the Fed, there was this increasing optimism around potential breakthroughs in trade negotiations. Specifically, there was a report from Politico indicating the White House was getting close, maybe nearing general trade agreements with both India and Japan.
Interesting. And it wasn't just those two nations signaling progress, was it? We also heard some whispers about maybe a cooling of trade tensions with China.
Precisely. Treasury Secretary Scott Bessent reportedly suggested, I think, in some private remarks, that the existing tariff standoff with China just isn't sustainable and that he anticipates a move towards de-escalation. Plus, President Trump himself stated that any eventual tariffs imposed on China wouldn't be anywhere near that 145% level that had been floated earlier, which is, a pretty significant pullback from those higher figures.
It really does suggest maybe a less confrontational stance there, at least for now. And it sounds like the positive developments on trade weren't just limited to those major players either.
That's right. There were also reports of, I think the term was significant progress in bilateral trade discussions. This was after meetings between Vice President J.D. Vance and Indian Prime Minister Narendra Modi.
Okay.
And you had analysts like Stuart Kaiser at Citigroup offering a broader positive view, suggesting we're likely to see successful trade negotiations with a whole range of key allies, Europe, South Korea, Australia included.
So it sounds like the prevailing market sentiment really did a 180. It shifted away from that Sell America feeling that Chris Weston at Pepperstone Group mentioned. We saw a clear reversal, didn't we?
Exactly, a real turnaround. You saw Asian equity benchmarks, which had taken a hit after President Trump's earlier tariff announcement back in April. They started to recoup those losses.
Right.
And notably, India was actually the first major market to fully recover. Then South Korea and Australia followed. So this rebound in Asian markets, it really underscores a broader easing of concerns about, widespread global trade disruptions.
And it wasn't just stocks reflecting this shift in mood, right?
Right.
We also saw movement in assets that are typically seen as sort of a safe harbor during turbulent times.
Correct. Yeah, we observed a sell-off in assets like gold and the Japanese yen. These are what we often call safe haven assets, things investors tend to flock to when they're feeling uncertain or risk-averse. So the fact that investors were moving out of these suggests, well, a greater appetite for risk. The immediate worries about U.S. economic policy and trade seemed to lessen, at least temporarily.
Okay, so we've seen this initial wave of optimism, this relief rally. But is it fair to say there are still maybe reasons to be cautious? It feels like we can't necessarily assume it's all smooth sailing from here.
That's a very insightful point, absolutely. While the immediate market reaction was positive, several analysts are really highlighting these persistent underlying uncertainties.
Okay.
For instance, Rupal Agrawal over at Sanford C. Bernstein emphasized that investors are still grappling with significant political and macroeconomic uncertainty. That hasn't just vanished.
And it's not just one voice expressing that caution, is it?
No, not at all. And Witi Bahuguna from Northern Trust Asset Management also advised against reading too much into these daily market swings, describing the current environment as one of, quote, extreme uncertainty.
Extreme uncertainty.
Yeah. It suggests that the fundamental factors that have been feeding the volatility haven't necessarily gone away completely.
What's particularly interesting, I thought, is that this underlying unease seemed to be showing up in the options market.
Yeah.
Can you maybe explain that a bit for those who aren't familiar? What does that tell us?
Sure. So essentially, the price of options contracts, which investors often use as a kind of insurance to protect themselves against potential losses, well, that price has gone up.
Okay.
The premiums people are willing to pay for this downside protection have actually reached levels we haven't seen since the flash crash back in 2021. Yeah. So think of it like the cost of insurance spiking. It indicates that despite the recent positive trend, there's still a significant level of background concern about potential, negative shocks down the road.
And we also have to factor in the bigger picture, right? The sort of global economic context, which doesn't seem to be painting a completely rosy scenario either.
That's a really critical layer to consider. You've got the International Monetary Fund, the IMF. They recently revised their forecasts downward for global economic growth for both this year and next.
Not great news.
Not ideal, no. And what's particularly noteworthy is their specific warning that the ongoing trade war, these trade tensions, could actually worsen the slowdown. So these domestic policy signals we've been discussing, they're playing out against this backdrop of potential global economic headwinds.
It's almost like these domestic policy shifts are in a bit of a tug of war with these potentially weaker global economic fundamentals. And just to add one more intriguing element to the mix, what's been happening with Bitcoin lately. It seems to be kind of moving to its own beat.
That's right. It's been interesting. Bitcoin recently surged above $90,000. That's its highest point since early March. What makes this particularly interesting for some observers is the suggestion that it might be decoupling, maybe breaking away from its traditional correlation with U.S. tech stocks.
Right.
Now, this could signal a changing perception of Bitcoin as an asset, perhaps influenced by some of the broader macroeconomic uncertainties we've talked about, with some investors maybe seeing it as an alternative store of value or maybe something else entirely. It's still early days on that interpretation, though.
Okay, so let's try and synthesize all of this, bring it together. What are the key takeaways, would you say, from this deep dive into these recent market movements?
Well, I think the first thing is that the immediate market jump we saw was largely a response to signals suggesting greater stability in U.S. economic policy,
That's right.
both on the Fed front and with trade relations. The market liked the apparent dialing back of potential disruptions. However, and this is the crucial but, it's vital to understand that This optimistic reaction is unfolding against a backdrop of really significant underlying political and macroeconomic uncertainty. That's highlighted by analysts like Agarwal and Bahuguna, and it's evidenced by things like the high cost of hedging in the options market. Plus, you layer on the IMF's more pessimistic outlook for global growth and its specific concerns about trade disputes, and that provides a really important broader context.
So the real aha moment here, maybe, is seeing how interconnected these seemingly disparate events truly are. Comments about the Fed chair, progress in some trade talks, global growth forecasts, even the price of Bitcoin, they all feed into the overall market narrative and shape how investors behave.
Exactly. It just underscores the complexity of the current economic environment. Investors are trying to navigate this situation where you have some positive signals, yes, but they're being weighed against these pretty significant concerns about long-term uncertainty and the overall health of the global economy. It's not straightforward.
This has been incredibly illuminating. Really appreciate you breaking it down. It just drives home the point that while those quick market swings grab the headlines, understanding the underlying dynamics is, well, absolutely essential. So for you, the listener, thinking about this, considering the IMF's warning about the potential for a worsening global outlook, maybe fueled by trade tensions, and given this persistent, extreme uncertainty that the experts keep pointing to, what specific indicators do you think you should be paying closest attention to really gauge the direction of the global economy beyond these short-term rallies? Definitely some food for thought as we navigate these interesting times.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.